Hi everyone, welcome back to my channel. In today's video, we're going to cover about dividend discount model and we will try some simple questions. So before we get started, let's talk about the dividend discount model. What is the core idea behind it? The core idea behind dividend discount model is that investors buy stocks for future cash flows. The value of any stock today is the present value of its future cash flows. And for shareholders, the most direct cash flow is dividends. So the dividend discount model values a stock as the present value of all future dividends. Okay, just to reiterate, the value of a stock today equals the present value of all future dividends investors expect to receive. Now, the Gordon growth model, which is going to be the focus of our class today, assumes that dividends grow at a constant rate forever. For that to happen, the company is assumed to be stable and mature. And also, we assume that the required return is greater than the growth rate. So, very simply, the price of a stock today is equal to the dividend paid next year divided by R minus G. For this equation, or for us to calculate the price today, R needs to be greater than G. The required return needs to be greater than the growth rate, otherwise this would be a negative number and would be meaningless. And G, the growth rate, needs to be constant. If the growth rate is not constant, then we are not able to use the Gordon growth model. This is the Gordon growth model. And as some of you might know, that this is very closely approximated to the growing perpetuity model. The growing perpetuity formula is C1 divided by R minus G is basically the present value of a product. Question 1, Gordon growth model. A company just paid a dividend of $2.50. Now, one of the biggest mistakes that students make is they don't grow the dividend that is paid currently by the growth rate. Look at the formula carefully, look at the subscript, it's D1 and price 0. So dividend at time 1 is based on the dividend at time 0 multiplied by 1 plus the growth rate. So dividend 1 is D0 multiplied by 1 plus the growth rate. Okay, so now if we do this question now, and we know that the required return is 9%, R is 9%, and it also provides that the growth rate is going to be 5% indefinitely. So G is 5%. Now for us to find the intrinsic value of the stock today, we can simply use our formula, which is going to be P0 is equal to 2.50 multiplied by 1.05 divided by 0.09 minus 0.05, and that would be our answer. Okay, so let me just calculate this. So it's going to be 2.50 multiplied by 1.05 divided by 0.06. That's 43.75. That's the price of the stock today. Okay, pretty simple, straightforward. The biggest mistake that students make again is that they treat this as dividend at time 1. Okay, so anything that says just paid yesterday, this represents the dividend that was paid one period prior. Okay, this signifies dividend at time 0. Now let's look at the question 2. The question 2 is the stock is currently priced at 40. The expected dividend next year is 2. Now this very clearly says the expected dividend next year is 2, which means that D1 is 2, and dividends are expected to grow at 4% indefinitely. What is the required rate of return? So if you use our formula, P0 is equal to D1 divided by R minus G, we can simply rearrange this and say R minus G is D1 divided by P0, and R in this case would be D1 divided by P0 plus the growth rate. Dividend 1 is already given to us as $2. P0 is given to us as 40 bucks. The growth rate is 4% indefinitely. So very simply, our answer would be 2 divided by 40 plus 0.04. And that happens to be 0.05 plus 0.04, which is 0.09. Okay, so simply rearranging the Gordon growth model can give us the estimate of the required rate of return for a stock. The last question we're going to do is the growth rate. A stock trades at $50. The expected dividend next year, again, expected dividend next year is $3. So again, let's start with our formula. P0 is equal to D1 divided by R minus G. Let's rearrange it and say R minus G is equal to D1 divided by P0. So G would be R minus D1 divided by P0. Okay, a stock trades at 50. The expected dividend next year is $3. So D1 is equal to $3. P0 is 50. R is 10%. So let's find the growth rate. Okay, the growth rate is simply going to be 0.10 minus $3 divided by $50. Okay, which is going to be 0.10 minus 3 divided by 50, which is 0.06, which is 0.04 or 4%. Okay, so we've done 3 basic intermediate level questions on the dividend discount model. Again, the idea is that the price of a stock today is based on the present value of its future cash inflows. For us to use this formula very carefully, we need to make sure that the growth needs to be constant. It's a perpetual rate of growth. Synonymously, it could be used as the constant rate of growth. It could be used as the growth rate forever. These are the terms that are used to denote that G is going to be perpetual. Hope you like this video. In our next class, we're going to talk about the dividend discount model. Where we're going to look at multiple stages of growth. Thank you and have a nice day.